Okay, let's dive right in. We're talking about building wealth today.
Yeah, a really crucial topic.
And there's this idea, this cultural thing that if you just work really, really hard, success and wealth will follow.
Right. The hard work pays off mantra. And look, hard work is definitely part of the equation. You can't get around that.
Sure.
But if it were the only thing, if wealth was just a direct result of sheer effort,
Then the rich list would look completely different, wouldn't it?
totally different. Think about it. Construction workers doing back-breaking labor day in, day out, or nurses. I mean, the stress, the long hours, life and death stuff.
Absolutely essential, demanding jobs.
Exactly. They'd be multimillionaires if hard work was the sole factor. But, well, it's pretty clear that's often not the case.
No, it isn't. Which really forces you to look at the underlying structure. What is the difference?
And the difference fundamentally comes down to ownership. It's not just about how hard you pedal the bike.
It's about owning the bike.
Mm,
Or maybe owning the whole bike factory.
precisely. True wealth isn't typically built from just a salary, no matter how high. It's built by owning assets.
Assets. Okay, define that for us in this context. What makes something an asset?
An asset is essentially something that makes money for you, ideally without you having to constantly trade your time for it. It's like buying or building a little machine that generates income.
While you sleep, as they say.
That's the classic definition, yeah. It should create cash flow or grow in value, appreciate, or build equity over time. If it requires your constant direct time input, it's still basically a job.
Got it. So owning things that work for you, that's the core idea.
That's the shift, moving from just earning to owning. And it's often a mindset shift first.
Which is exactly what we want to explore in this deep dive. We're going to unpack, 15 different types of assets?
15 specific ones, yeah. We'll cover the traditional bedrock assets, but also dive into some of the newer, maybe digital frontiers.
The goal here is to really understand the strategy behind each one. How do they actually help you break free from that cycle of just trading hours for dollars?
And we're setting a clear standard. For something to count as an asset on this list, it needs to potentially pay you, either through income, growth, or equity.
Not something that just costs you money,
Yeah.
like my fancy coffee machine, maybe.
Or, more commonly, like a new car that loses value the second you drive it off the lot.
Yeah.
That's a liability. We're focused on the opposite things that add to your net worth over time.
Okay, let's get into the specifics. Section 1. The bedrock assets. These are the classics, the tangible ones. Starting with number 1, real estate.
Ah, the big one. Real estate. It's timeless for a reason.
Yeah, people say it's created more millionaires than anything else historically. Why is it so consistently powerful?
Well, it attacks wealth building from multiple angles. You usually hear about the main three: cash day from rent,
Right, the monthly income?
equity buildup, which happens as you pay down the mortgage or as the property value goes up relative to the loan.
So you own more of it over time.
Exactly. And then there's appreciation, the property hopefully increasing in market value over the long run.
Okay, cash flow, equity, appreciation. That makes sense.
But there's a fourth element, a sort of superpower that sophisticated investors really understand and use, and that's leverage.
Leverage, using borrowed money, right?
Right.
Other people's money, OPM.
Precisely. This is where real estate truly shines compared to many other assets.
Yeah.
Let's say you want to buy $100,000 worth of stock. How much cash do you generally need?
$100,000.
Right. Now, let's say you want to buy a $100,000 rental property. You might only need to put down, say, 20%, so $20,000.
Okay.
But you now control a $100,000 asset. You're using the bank's $80,000. So if that property value goes up by just 10% to $110,000,
You've made $10,000 profit.
yes, but what was your return on the cash you actually invested? You put in $20,000 and made $10,000.
Wow, that's a 50% return on my cash, not 10%.
Exactly. That's the power of leverage. It magnifies your gains. And yes, also your risks, we should note, but used wisely, it dramatically accelerates wealth building.
That is huge. And are there other, maybe less obvious benefits?
Like taxes? Oh, absolutely. Real estate often comes with significant tax advantages. One of the big ones is depreciation.
Depreciation. That sounds negative, like the property is losing value.
Well, for tax purposes, the government lets you assume the building part of your property is wearing out over time, even if the market value is actually going up.
Okay.
So you get to deduct this paper loss, the depreciation expense, against your rental income each year.
So you might be collecting real cash rent, but on your tax return, that income is reduced or even wiped out by this depreciation deduction.
Correct. It means your actual cash flow can be very tax efficient. You're earning money, but paying less tax on it than you might on, say, salary income.
Incredible. So leverage and tax benefits are key drivers.
Definitely. And underneath it all is the fundamental point. Land is finite. They're not making more of it.
Right. Demand tends to grow, supply is limited.
Whether it's a single-family rental, a big office building, farmland, or even, a parking lot in a busy city, owning that physical space is powerful.
Okay, that brings us nicely to asset number 2, farmland. You mentioned it. Why is this considered a hidden gem?
It's a hidden gem because it's kind of boring compared to tech stocks or crypto maybe, but it offers incredible stability.
Stability,
Yeah,
because
it's food.
exactly. The core driver is simple. People always need to eat. Always. Doesn't matter if the stock market crashes or there's a recession. Food demand is constant.
And it's a hedge against inflation too, I imagine.
A very good one. When prices for everything else go up, food prices tend to rise, and so does the value of the land that produces the food. It's fundamentally tied to basic necessity.
So how does an investor actually make money from farmland, assuming they're not, driving the tractor themselves?
2 main ways. You could potentially share in the crop yield, though that's more complex. More commonly, especially for passive investors, you buy the land and then lease it out to experienced farmers.
So you get steady rental income. Right. Farmers pay you rent to use your land. These are often stable, long-term leases. And meanwhile, the underlying asset, the land itself, tends to appreciate over time.
Why does it appreciate? Just population growth.
Population growth is a big factor, absolutely. More mouths to feed globally. Plus, the amount of arable land, good quality farmland, is actually shrinking in some areas due to development or climate change. So scarcity plays a role too.
It's interesting. You hear about very wealthy, very strategic investors getting into farmland, like Bill Gates, right?
Yeah, that's a well-known example. When people like Gates make significant investments in farmland, it's not usually a speculative gamble.
It's a stability play.
It's a long-term strategic move. They see the stability, the inflation protection, the essential nature of the asset. It's like portfolio ballast. It adds weight and stability against more volatile investments.
Okay, moving from the soil to something shinier.
Okay.
Asset number 3, precious metals, gold and silver.
Right. Now, it's really important to frame these correctly. Gold and silver, for most sophisticated investors, aren't primarily about getting rich quick.
They're not growth assets.
Not usually, no. Think of them more like wealth protection, an insurance policy for your capital.
Insurance against what?
Against instability in the financial system.
Yeah.
They are tangible. You can hold them in your hand. They are finite. Unlike paper money, governments can't just print more gold.
Okay.
And they have this incredibly long history, thousands of years, of being universally recognized as a store of value. They don't rely on any single government or bank for their worth.
So their value is kind of intrinsic, independent.
Largely, yes. Which means they tend to perform well, or at least hold their value, when other things are falling apart.
Like during a market crash.
Exactly. Or periods of high inflation when paper money is losing its purchasing power rapidly, or times of major geopolitical uncertainty. When faith in the system wavers, capital often flows into tangible, trusted assets like gold and silver.
So they provide stability when everything else feels shaky.
Yeah.
But they don't usually generate income, right? Like rent or dividends.
Generally, no. You don't earn interest sitting on gold bars. Their main role is preserving purchasing power over the very long term and acting as that counterbalance during crises.
Got it. Protection, not high growth. Okay, final one in this bedrock section. Asset number 4, bonds.
Bonds. Again, maybe not the most exciting topic for some.
Yeah, sounds a bit dry. Lending money.
Essentially, yes. When you buy a bond, you're lending money to an entity. It could be the federal government treasury bonds, it could be your city or state municipal bonds or munis, or it could be a large corporation, corporate bonds.
And what do you get in return for lending the money?
You typically get regular fixed interest payments over a set period, and then at the end of that period, the maturity date, you get your original principal back.
So it's predictable income.
Very predictable, usually. That's the main appeal. It's generally much lower risk than stocks. Wealthy investors use bonds to balance out the riskier parts of their portfolio.
Okay, but is there more nuance to it? Do sophisticated investors just buy any bond?
Not necessarily. They often look closely at things like credit quality, how likely is the borrower to repay, and also the tax treatment.
Tax treatment. How does that apply to bonds?
Well, interest from treasury bonds is usually exempt from state and local taxes. And interest from municipal bonds is often exempt from federal income tax, and sometimes state and local too, especially if you buy bonds issued in your own state.
Ah, so for someone in a high tax bracket, that tax-free income from a muni bond could be much more valuable than slightly higher but fully taxable income from a corporate bond.
Precisely. They're looking at the after-tax return and the safety. It's about capital preservation and generating steady, reliable income, often with tax advantages.
But what about risks? I hear about interest rates affecting bond prices.
That's the main risk, called interest rate risk or duration risk, because the bond pays a fixed interest rate. If overall interest rates in the economy go up after you buy your bond, newer bonds will be issued with higher rates.
So my older, lower rate bond looks less attractive.
Right. Its price on the secondary market would likely fall to compensate. Conversely, if interest rates fall, your existing bond paying a higher fixed rate becomes more valuable.
Okay, so they're not totally risk-free, but they offer predictability and safety compared to stocks.
Exactly. They're the safety net. They provide that slow, steady income and help cushion the portfolio when markets get volatile, essential for balancing risk.
All right, let's shift gears into section 2. Here we're talking about investing in the financial systems themselves. Asset number 5, stocks.
Stocks or equities, owning shares in publicly traded companies.
Now, the key mindset shift here you mentioned earlier is crucial, viewing the stock market not as a casino for quick bets.
Definitely not. But as a tool for ownership, you're literally buying a small piece of a business, maybe Apple, maybe a utility company, maybe hundreds of companies.
You become a part owner.
Yes. And as an owner, you generally benefit in 2 main ways. First, through dividends.
Yeah, it's when the company shares some of its profits with shareholders.
Correct. Regular payments, often quarterly, it's like getting your share of the earnings. The second way is through capital gains or appreciation.
The stock price going up over time.
Right. If the company does well, becomes more profitable, or is expected to grow, its stock price tends to rise. If you sell it later for more than you paid, that's a capital gain.
So dividends for income, capital gains for growth. But what's the real engine here? Why has the stock market historically been such a powerful wealth builder over the long term?
2 words. Compounding returns.
Ah, the magic of compounding.
It really is almost magical. It's where your returns start earning their own returns. Your dividends get reinvested, buying more shares, which then earn more dividends. Your capital gains increase the base value, so future percentage gains are on a larger amount.
It snowballs.
It snowballs over time. That example you often hear, like $10,000 invested in a broad market index like the S&P 500 20 years ago becoming, say, $60,000 or more today, that wasn't just steady upward growth. A huge part of that is the compounding effect, money making more money. But it requires patience.
Patience. And maybe courage. Because markets don't just go up, do they? They crash sometimes.
They certainly do. And that's where the behavioral difference between successful long-term investors and, well, everyone else really shows up.
What happens when the market drops, say 20%? What does the average person often do?
Panic often sets in. Fear takes over. They see their account value dropping. They worry it'll go to zero, so they sell, often near the bottom.
Lucking in their losses.
Exactly. But what does the seasoned long-term investor do? Someone with that ownership mindset.
They see it differently.
They often see it as a sale, like their favorite store is having a 20% off sale on high-quality goods. They understand that market downturns are temporary, historically speaking.
So they might actually buy more.
Often, yes. If they believe in the long-term value of the businesses they own shares in, a dip is an opportunity to acquire more ownership at a lower price. They have the discipline to stick to their strategy and the time horizon thinking in decades, not days.
That psychological edge seems critical.
It's arguably the most important factor for success in stock investing over the long haul. Temperament over intellect sometimes.
Okay, but what if someone doesn't have the time or maybe the inclination to research individual companies? It sounds like a lot of work.
It can be. And that's where asset number 6 comes in. Index funds and ETFs.
Index funds and exchange-traded funds. These are solutions for people who want diversification without picking individual stocks.
Exactly. They're brilliant, relatively simple tools. An index fund or an ETF that tracks an index holds shares in all the companies within a specific market index.
Like the S&P 500.
That's the most common example, yeah. So by buying just one share of an S&P 500 index fund or ETF, you instantly own a tiny piece of all 500 of the largest companies in the U.S.
Wow, instant diversification.
Maximum diversification, really easily. If 1 or 2 companies in the index have a terrible year, it has only a small impact on your overall investment because they're just a small part of the whole basket.
And they're usually low cost, right? That's a big selling point.
Typically very low cost, yes. Because the fund manager isn't actively trying to pick winning stocks, they're just passively tracking the index, buying and selling stocks only when the index itself changes. Lower activity means lower management fees.
I remember hearing Warren Buffett often recommends low-cost S&P 500 index funds for the average person, which is kind of ironic coming from arguably the world's best active stock picker.
It is ironic, but it's based on data. Study after study shows that the vast majority of professional active fund managers fail to consistently beat their benchmark index over the long term, especially after you account for their higher fees.
So even the pros struggle to beat the average.
They do. So Buffett's advice is essentially, since beating the market is really hard, just buy the market average as cheaply as possible and let compounding do its work.
It sounds like the perfect set it and forget it strategy.
For many people, building long-term wealth, it really is. You invest regularly, keep costs low, stay diversified, and focus your energy elsewhere, like on earning more money to invest. It lets your financial engine run quietly in the background.
But quick question on that. If everyone just passively invests in index funds, who's actually doing the work of figuring out what companies are worth, does active investing still matter?
That's a great question, and it's a real debate in finance, sometimes called the paradox of skill or the efficiency paradox. The theory is you still need active investors buying and selling based on research to make market prices reasonably efficient.
So passive investors kind of rely on active investors to set the prices.
To some extent, yes. But for the individual investor's goal of wealth accumulation, the practical benefits of low-cost, diversified passive investing overwhelmingly outweigh that theoretical market structure concern. Simplicity and consistency usually win for individuals.
Okay, that makes sense. Now let's move to something quite different, much higher risk. Asset number 7, venture capital or VC.
Right, venture capital. This is investing in private startup companies before they become household names, before they go public via an IPO.
So investing in the next potential Google or Amazon when it's just starting out?
That's the dream, yes. You're funding innovation at its earliest, riskiest stage. You're betting on the founder's vision, the team's execution, the market timing.
Sounds exciting, but also really risky.
Extremely risky. The failure rate for startups is very high. A typical VC fund might invest in, say, 10 companies. They might expect 8 of those to fail completely or only return the initial investment.
8 out of 10.
Yeah, or maybe even more. The entire fund's success relies on the 1 or 2 companies that do succeed, delivering massive returns like 10x, 20x, or even 100x the initial investment to make up for all the losses and still provide a great overall return.
So it's a hits-driven business. Go big or go home.
Very much so. The goal isn't small, steady profits. It's finding and funding disruptive companies that can achieve exponential growth and fundamentally change an industry.
Who typically invest in VC. It's not something most people can just buy into, right?
No, typically not directly. VC investing is usually restricted to accredited investors, people with high income or net worth, or institutions like pension funds and endowments.
And how is it structured? Do they just write checks directly to the startups?
Usually they invest through a VC fund. Wealthy individuals or institutions become limited partners, LPs, in the fund, committing capital. The fund itself is run by general partners, GPs, the experienced venture capitalists who find the deals, invest the money, sit on the boards, and manage the portfolio.
So the LPs provide the capital and trust the GPs to find the winners.
Correct. The LPs get exposure to that potential massive upside. Think about the returns for early investors in Uber, Airbnb, Spotify.
Tronopical.
Potentially, yes. But they also accept the high risk, the lack of liquidity. You usually can't get your money out for many years, often 7 to 10 years, and the reliance on the GP's expertise. It requires deep pockets, a long time horizon, and a strong stomach for risk.
Okay, section 3. This feels like where things get really interesting in the modern era digital, creative, scalable assets. Asset number 8, businesses. Specifically, owning them.
Yes, owning a business. And this, arguably, is the ultimate wealth-building asset.
Why the ultimate? More than real estate or stocks?
Because when you own the business, you control the system. You control the cash flow, the strategy, the hiring, the product, the potential exit. Your upside isn't capped like a salary. It's potentially unlimited.
And crucially, once it's set up right, your income isn't directly tied to the hours you personally put in each day.
That's the key distinction. You move from working in the business to working on the business. You build systems, processes, teams, automation, so the business can operate and generate revenue largely independently of your constant presence.
But let's be real. Starting a business is incredibly hard work, isn't it? Especially at the beginning. Unlimited upside sounds great, but what about the unlimited stress?
Oh, absolutely. The initial phase is often brutal. Long hours, low pay, high stress, constant uncertainty. That's the barrier to entry, the trial by fire that stops most people.
So how do successful owners get past that?
They understand they're not just doing tasks, they're building an asset. They have a long-term vision. They focus on creating that infrastructure, the team, the systems, the scalable model that will eventually allow them to step back from the day-to-day grind. Their goal is to build something that runs without them.
Think about the biggest names, Bezos, Musk. They didn't get super rich from salaries.
Not at all. They got rich from the ownership stake in the incredibly scalable systems they built. Amazon, Tesla, SpaceX, businesses that can multiply value across millions or billions of customers.
What do successful, scalable businesses look like today, especially for someone maybe starting smaller?
Often, they're digital and leverage technology. Think about things like a niche software as a service SaaS tool that solves a specific business problem.
Right, subscription software.
Or a really well-run e-commerce store with a strong brand and automated fulfillment. Or maybe an online education platform selling digital courses on a popular topic.
YouTube channels even, with large audiences.
Definitely. A monetized YouTube channel or a popular blog can absolutely be a scalable business asset. The common thread is leveraging technology to reach a wide audience with relatively low marginal costs per additional customer or viewer. High initial effort, but potentially infinite scalability.
That scalability idea leads perfectly into asset number 9, intellectual property or IP.
Yes, IP. This is often overlooked because it's intangible. You can't physically touch it like real estate.
Right.
But its power is immense.
Oh, what counts as IP?
It's basically creations of the mind that have commercial value and can be legally protected. Think books, music, movie scripts, software code, unique designs, patents for inventions, even online courses.
And the power here is
Yeah.
you create it once.
Often, yes. The core power is generating ongoing income from a one-time creative effort. You write the book once, compose the song once, develop the software once.
And then it can potentially earn money for years or even decades.
Exactly. Through sales, licenses, royalties. Without you necessarily having to put in much more work on that specific creation, it decouples your time from your income potential.
How do you protect this IP asset, though, if it's just an idea or a digital file?
Through established legal frameworks. Copyright protects the specific expression of an idea, the words in your book, the melody of your song. It usually lasts for the creator's lifetime, plus many decades.
Okay.
Patents protect the functionality of novel inventions, usually for around 20 years. Trademarks protect brand names and logos. Savvy IP owners invest in getting these protections properly registered and enforced.
And the scalability, especially now with digital platforms.
It's incredible. Think about Amazon Kindle Direct Publishing for authors. Anyone can publish a book globally with minimal upfront cost. Or Spotify for musicians. Or platforms like Udemy or Teachable for course creators.
They allow you to turn your idea, your IP, into something that can be sold millions of times around the world.
Pretty much. The cost of delivering one more digital copy, an ebook download, a music stream, access to an online course is virtually zero. So after you cover your initial creation costs, almost every subsequent sale is pure profit. That's insane leverage.
Wow. Okay, and that ties into asset number 10, which is a specific type of income from IP, royalties.
Right. Royalties are the payments you receive when someone else uses your licensed intellectual property.
So it's not just about selling your book directly, it's about licensing the rights.
Exactly. Maybe a movie studio options your book. Maybe a company licenses your patented technology.
Yeah.
Maybe a musician's song gets used in a commercial or played on the radio.
Or even stock photos.
Great example. A photographer uploads their photos to a stock photo site. Every time someone downloads and uses one of those photos, the photographer gets a small royalty payment. If they have thousands of popular photos downloaded millions of times,
Those micropayments add up.
they can add up significantly. It's a really elegant form of income because it flows directly from your past creative work. You do the work once, set up the licensing, and potentially receive payments for years with no additional effort for that specific piece of work.
It feels very passive, in the true sense.
It's one of the purest forms of passive income, yes. The value is tied entirely to the demand for your unique creation. Building a portfolio of different royalty streams is a really smart strategy for hands-off income.
Let's shift slightly, but stay in the digital realm. Asset number 11, digital real estate.
Digital real estate. This is a fantastic modern analogy, just like owning a physical building on a busy street.
You own a valuable location online.
Exactly. This means things like established high-traffic websites or blogs in a specific niche, or valuable domain names, or large engaged social media accounts or online communities. You own the platform and the audience's attention.
And attention is the currency online.
Right. It absolutely is. If you own a website that consistently gets, say, 100,000 visitors per month interested in a particular topic, that's like owning a prime piece of digital land on a very busy street.
How do you monetize that attention? How does the rent come in?
Several ways. You can display advertising companies pay to put their ads in front of your audience. You can use affiliate marketing, recommending other people's products and getting a commission on sales.
Sponsorships too.
Definitely. Brands might pay you directly to feature their product or service to your audience, or you could sell your own digital products or services directly to that audience. The platform itself is the asset that generates these income streams.
And can you sell the entire digital property, like you sell a physical building?
Yes, absolutely. There's a whole market for buying and selling established websites and online businesses. They're often valued based on a multiple of their monthly or annual net profit.
So a website earning $5,000 a month might sell for what?
It depends on the niche, the stability, the growth potential, but maybe somewhere in the range of 30 to 45 times monthly net profit. So $150,000 to $225,000 potentially.
Just for the website and dead traffic? Wow.
Yeah. You're buying the system, the audience, the cash flow. It's a tangible asset in the digital world. You own the attention flow.
All right, Section 4 takes us into some alternative assets, maybe even disruptive ones. Let's start with a controversial one. Asset number 12, cryptocurrency.
Ah, yes, crypto, Bitcoin, Ethereum, and the thousands of others. Definitely controversial, definitely volatile.
But you're including it as a potential wealth-building asset.
We have to acknowledge it, yes.
Yeah.
But with important caveats. Sophisticated investors who are involved in crypto generally aren't just blindly buying coins hoping they go to the moon.
They have a strategy.
They usually view it through a couple of lenses. Some see Bitcoin, for instance, as a potential form of digital gold, a scarce, decentralized store of value that could act as a hedge against inflation or government currency debasement.
Okay, similar to physical gold's role.
Potentially, yes, though much newer and more volatile. Others are more interested in the underlying technology, the blockchain. They might invest in platforms like Ethereum, seeing it as the foundational infrastructure for a new wave of decentralized applications and finance.
So it's about the utility, not just the price.
For many serious investors, yes. They might be involved in DeFi, decentralized finance, using their crypto holdings to lend, borrow, or earn yield through mechanisms like staking.
Staking, what's that?
In many newer blockchains using proof of stake, you can stake your coins, essentially locking them up temporarily to help secure the network and validate transactions. In return, you earn rewards like interest or dividends. It's a way to generate passive income from your crypto holdings by participating in the network.
So it's more complex than just buying and holding.
It can be, yes. The key point is it's a very new, evolving, and high-risk asset class. The skepticism today feels a bit like the skepticism around the internet in the mid-90s. Huge potential for disruption, but also huge uncertainty and risk. It requires serious research and shouldn't be a large part of most people's portfolios unless they truly understand it.
Got it. High risk, high potential, needs deep understanding.
Yeah.
Okay, let's pivot to something much more tangible again. Asset 13, collectibles.
Collectibles. Things like rare art, vintage cars, fine wine, high-end watches, maybe even rare sneakers or trading cards now.
This used to be just a hobby, right? But now it's seen as a real asset class.
It's increasingly seen that way, yes, especially by high-net-worth individuals looking for diversification away from traditional stocks and bonds. These assets often have low correlation to financial markets.
What drives their value? Just rarity.
Scarcity is the primary driver, yes. There's only one Mona Lisa, only so many 1962 Ferrari GTOs, only a limited number of first edition Action Comics #1. When demand from wealthy collectors meets that fixed finite supply, prices can go astronomical.
But it seems like a tricky market to navigate. How do you know if something is authentic or what it's really worth?
That's the challenge. Authentication, proving it's genuine, and provenance tracing its history of ownership are absolutely critical. This often requires experts, appraisals, and careful documentation. It's not like buying a share of stock.
And they don't produce income, usually. Plus,
Yeah.
they cost money to own, right?
Exactly. They are generally non-income producing. And they come with significant carrying costs, storage, sometimes climate-controlled, insurance, maintenance, security. Plus, they're highly illiquid.
Meaning hard to sell quickly.
Very hard. Selling a rare painting or vintage car can take months or even years to find the right buyer at the right price through auctions or private dealers. So it's a diversification play, maybe a passion investment, but requires specialized knowledge and isn't easily accessible or manageable for most people.
Okay. Now, asset number 14 is luxury real estate. How is this different from the regular real estate we discussed earlier?
We're talking about the very top end of the market here. Penthouses in major global cities, sprawling estates in exclusive locations, private islands, super prime villas.
The kind of properties you see in magazines.
Pretty much. The key difference isn't just price, it's the element of extreme rarity, prestige, and often global appeal. These properties function less as typical investments focused on rental yield and more as a global store of wealth for the ultra-rich.
A store of wealth. Like gold, but you can live in it.
Kind of, yeah. And interestingly, this segment of the real estate market can sometimes behave differently from the general housing market.
How so? Is it more stable?
It can be surprisingly resilient during economic downturns. While the regular housing market might suffer, the demand for truly unique, ultra-luxury properties often holds up better.
Why is that?
Because the buyer pool is very small, very international, and often less affected by typical economic cycles. They're seeking security, exclusivity, and a tangible asset to park significant capital. The scarcity factor is extreme at this level, and that persistent demand from the global elite can keep prices stable or even rising when other markets are falling.
So it's about preserving wealth and status as much as investment returns.
Exactly. It's a unique asset class driven by scarcity, prestige, and the needs of the ultra-high net worth demographic.
We've covered 14 distinct asset classes, from tangible land and gold to intangible code and online attention. But now we get to asset number 15, and you argue this is the most important one.
Absolutely. Hands down, the most critical asset you will ever own. And that asset is yourself.
Myself. How is that an asset?
Think about it. All the other assets we discussed, real estate, stocks, businesses, crypto, they can all be lost. Markets can crash, businesses can fail, properties can be destroyed, bad luck happens, bad decisions happen. But if you have invested consistently in yourself, in your knowledge, your skills, your mindset, your health, your network, you possess the underlying engine that can rebuild wealth. If you lose everything financially but still have your capabilities, you can earn it back.
So my skills and knowledge are the ultimate safety net.
They are the ultimate productive asset. Money can be taken away, but competence and capability, once acquired, are much harder to lose. This isn't just fluffy self-help talk. It's a core strategic principle for long-term wealth.
How do wealthy or successful people strategically invest in themselves then? What did that look like in practice?
They treat it like a serious investment, often with a dedicated budget of time and money. It means continuous, targeted learning, not just casual reading, but deep dives into their industry, acquiring new high-value skills, maybe hiring coaches or mentors.
Upgrading their own mental operating system.
That's a great way to put it. They understand that their personal capacity dictates the level of problems they can solve and the value they can create in the world. The bigger the problems you can solve, generally, the greater the rewards.
It also includes things like networking, building relationships.
Crucial. Investing time in building a strong network of talented, ethical people provides access to opportunities, information, and support that you just can't get otherwise. Your network is part of your personal asset base.
And you mentioned health, too. Why is that so critical from a wealth-building perspective?
Because health is the foundation for everything else. It's your energy source, your platform for execution. If you're constantly tired, sick, stressed out, or mentally foggy,
Your decision-making suffers.
dramatically. Your ability to manage your other assets, run your business, perform at your job, learn new things, it all declines. Wealthy individuals often prioritize health, rigorously exercise, nutrition, sleep, stress management, because they understand it's not an expense, it's an investment in their primary asset. It fuels longevity and high performance.
So investing in yourself has its own kind of compounding effect.
It's the ultimate compound effect, really. The more valuable you become, more skilled, more knowledgeable, healthier, better connected, the more valuable your time becomes, the better your ideas are, the more effectively you can manage other assets, and the more resilient you are to setbacks.
It powers everything else.
It truly does. It's the engine. You can't build a sustainable fortune on a shaky personal foundation. Investing in yourself is investing in the core driver of all future wealth creation. Outro.
Wow, okay, so that's 15 assets. A really diverse list, covering everything from physical land
Yeah, real estate, farmland, precious metals,
to financial instruments like stocks and bonds,
to digital creations like IP and websites.
and finally the ultimate asset, ourselves,
It's a broad landscape, but hopefully the connecting thread is clear.
which is
The unifying concept is the shift from earning to owning. Wealthy people focus on acquiring and building assets, systems, properties, investments that generate income, appreciate in value, or build equity, ideally with leverage and tax efficiency, and often independently of their direct time input.
they make money work for them instead of just working for money.
That's the fundamental difference in strategy.
So for you listening, what's the key takeaway? You don't need to go out and buy, a venture capital fund tomorrow.
Definitely not. The actionable advice is usually much simpler. Start somewhere. Start small, maybe, but start building consistently.
Pick one area.
And maybe pick one asset class from this list that resonates with you, that fits your current situation and risk tolerance. Maybe it is just consistently investing in a low-cost index fund each month.
Or maybe it's starting that side project to build a small piece of digital real estate.
Or maybe it's consciously investing time and resources into learning a specific high-income skill, investing in yourself.
The key is consistency and focusing on that ownership principle, building something that can grow over time.
Exactly. Patience and consistency almost always win over trying to get rich quick. Focus on building a solid foundation.
Which brings us to our final thought for you to consider. We've talked about the shift from working for money to making money work for you.
Yeah. That critical transition point.
So the question to leave you with is this. Which one of these 15 assets, or maybe just the principle of investing in yourself, are you going to prioritize investing in, starting today, to begin making that powerful shift?